Principles of trading. Majority of the time technical analysis is leveraged by the short-term traders and sometimes by long-term investors. Day trading is not easy for all traders. There are huge possibilities of losing money. You need to make experiments with different methods and gain some experience, and then it would be easy for you to generate profit regularly. The stock market always remains highly volatile, and therefore, you may make mistakes and lose money. That's the reason you need to follow the principle of trading. 1. Do trade, not gamble. Some traders believe that trading is gambling. Gamblers trade their money in the hope of earning money without having proper understanding of how the stock market works. This is the wrong method to make money. It may cause massive amounts of losses. Trading is like a business, which needs experience, good planning, strategies, and knowledge. The trading involves executing the plan, evaluating different strategies, analyzing past data, learning techniques, and doing lots of research. Traders are always alert to find an opportunity to buy it cheap and sell at a high price. Trading requires mathematical calculations, analysis of market trends, analysis of past trends, prediction of future price, etc. The most important thing in trading is consistency. Always consider the fact that the market will always remain extremely volatile and unpredictable. You should not trade based on your luck and try to make money. Therefore, in order to trade properly, you need to do research and analysis. 2. Plan your trade and trade your plan. Plan your trade and trade your plan. This quote applies to intraday traders. That is the most important principle for trading. Successful traders always prefer to develop a trading strategy and calculate the formula. A person cannot jump into the water without learning to swim. You cannot make your body in a proper shape without going to the gym. Same thing, we can apply in trading. A trader should not trade in the market without planning. There are many situations where traders need to modify their trading plan during the market session. But it is always advisable that traders should plan before the market starts. Do not make emotional decisions while trading. 3. Learn to lose. Even after following proper strategies, one does not have to win all the time to be profitable. Sometimes strategies don't work out. Learning to lose is part of trading. Sometimes losing a small battle helps to win a big war. But there are many ways to avoid big losses. Always set a stop loss for your trade. Traders should know how much risk they can take per trade. They can use risk management techniques, we have seen in the risk management videos, to identify the percentage of risk. Traders need to calculate the position sizing, set the entry and exit points, and find the best place to put the stop loss. 4. Start small. As a beginner, always start with a small amount of money and focus on 1 or 2 trades during the session. Start with small and increase position sizing only if you are profitable. If traders start with small, they will gain experience of the changing trends. They can identify which strategy is applied in which situation and build successful winning trades. 5. Be careful of over-leverage and over-trading. Be careful while trading on over-leveraged instruments such as futures and forex trading. They are the most traded market in the whole world. Over-trading is also a dangerous thing to do. When a trader does excessive buying and selling in the financial market, it is known as over-trading. Traders do overtrade when they have benefited from previous trades and have the confidence to trade more. But it is the worst decision ever made by traders. Without making a strategy, traders may lose their capital. 6. Trade with a clear mind. Think with a clear mind. There are many factors and emotions that affect the most while trading. Sometimes a small thing disturbs your mind. A small fight with your loved ones, illness, business problems are the factors that can affect you while trading. 7. Control your emotions. When we talk about money, emotions take place and disturb your mind. The trader needs to take care of 3 emotions: fear, excitement, and greed. Fear. Sometimes traders trade with large sizes and have a fear of losing money. Excitement. Traders get excited when the market is moving heavily. They think that they would lose the opportunity to enter the market. And therefore, without a strategy, they trade in the market and make big losses. Greed. When traders make money, they want more profit. Your greed can be the result of losing all your capital. Conclusion. These principles are helpful to do successful trading. Always focus on learning. The more you learn, the more money you can make by trading. Also, a trader should always update himself with recent news, events that affect the stocks.